Hey everybody, welcome to guided assignment for chapter 13. This is where we're going to create a statement of cash flows using the indirect method. And we're given a comparative balance sheet and we're given some additional information from the income statement, but we can't see all of that. So anyway, so the way this is set up, we have the income statement and info up here, then you have to scroll down and you can see the fields you have to fill on the statement of cash flows. It kind of stinks because there's like a bunch of scrolling. So I'm actually going to, I think I'm going to split my screen and then I'm going to use my snipping tool to take a picture of this stuff from up here. That way I don't have to be scrolling up and down through the whole problem. You can do that if you want. You can also scroll up and down. You can also take a picture of it with your phone camera. I see a lot of people doing that in class. You can do whatever works best for you. Like I said, I just don't like all the scrolling, so I'm gonna set it up that way. Try to get my calculator over in here too and see if we can keep it all straight. Okay, so anyway, so here's all our information. We have our comparative balance sheet, and then we have this additional data. So here we go on our statement of cash flows. We will start. We always, on an indirect method of statement of cash flows, we start with the net income for the year we're doing the statement of cash flows for. So normally we would look on the income statement, but in this problem it's given to us here as item A. So I'll just start with my net income. That's always my step one. And then we'll begin to make adjustments to reconcile our net income to our cash flow. The first adjustment always to make is to look for expenses that are non-cash. And so the most common one is depreciation expense. That's the one you're going to see the vast majority of the time. Sometimes there's amortization on things like intangible assets, but the most common will be the depreciation. And we'll see right here on B, it tells us depreciation reported on the income statement was $49,600. So what I'm going to do is I'm going to add that amount, 49,600, back into the net income. The reason is on the income statement, depreciation expense will reduce the amount of net income, but it won't reduce the amount of cash. So by adding depreciation expense back to the net income, we're bringing that in line with the amount of cash they would have actually received. Then we're going to make adjustments for changes in the current operating assets and liabilities. Like I said in the lecture, if you don't want to try to talk yourself through the logic of why, at least remember the rule, which is if assets are opposite, meaning if an asset increases, we'll adjust cash down, and if an asset decreases, we'll adjust cash up. And then liabilities are the same, meaning if a liability increases, we'll adjust cash up, and if a liability decreases, we'll adjust cash down. I'll try to talk through the logic of that, but if you can't remember the logic, at least remember the rule. So I'll look at my first current asset, which is accounts receivable, and I can see last year it was 144,420. This year it was 134,320. So I can see that there's been a decrease in my accounts receivable. So I'm going to make an adjustment to cash for a decrease in accounts receivable. I'll subtract 144. I'll subtract 134,320 from 144,420 to find out the amount. To find out the amount of the difference. 144,420 minus 134,320. So I had a difference of 10,100. So think of it this way: accounts receivable is money owed to me by my customers. If that amount has decreased, gone down by 10,100, that means that I've collected 10,100 that was not cash before, was money owed to me, that is now cash. And so I've added that much cash. Again, the logic would be if my accounts receivable stayed exactly the same from one year to the next, that would mean that I collected amount from customers equal to the amount of my net income. But if my, or equal to the amount of my sales, sorry. But if it goes down, that means I collected more than the amount of my sales, which is why we're going to adjust cash up if the asset goes down. Or if it were to go up, it would mean I didn't collect all of my sales. So in this case, we have a decrease of 10,100. So we're going to increase or adjust our cash upward by 10,100. The second one is my inventories. You can see I have an increase in my inventories. Again, I'll subtract the smaller one from the larger one. So 191, 880 minus 178, 990. And that will tell me the amount of the difference between the two. So my inventories increased by 12,890. Again, if I apply the rule, an increase to an asset is going to be a decrease to cash. So I'll put that on my balance sheet, minus or a subtraction of $12,890. And again, the logic would be this: if I replaced all of my inventory that I sold exactly the same amount, then my inventory amount would not change. But if I bought more inventory than the amount of inventory I sold, then my inventory would go up, which would cost me cash. If I were to not replace all of my inventory, then my inventory would go down, which means I would have saved on cash. And so again, the rule is if an asset increases, we'll do a reduction or a decrease on our cash adjustment. And if an asset were to go the opposite way, were to decrease, then we would do an increase to cash. Our third one here is prepaid assets. We had an increase in prepaid assets. Sorry, prepaid expenses. Subtract the smaller one from the larger one, so 7820 minus 5420. Tell me how much it increased. Increased by 2,400. So an asset increasing means we'll do a decrease in cash. Then once we finish that one, we see we're into equipment, which is not a current asset, but a property, plant, and equipment, or a long-term asset. So we're not going to do an adjustment for that. That will be part of our investing activities. We come down here into our liabilities. We'll see we had accounts payable. That accounts payable increased. We'll do an adjustment for an increase in accounts payable. Since it's a liability, the rules are if an increase to liabilities means an increase to cash, and a decrease to liabilities is a decrease to cash. So we'll subtract to find the difference. 149, 250 minus 141, 700. So we can see our accounts payable increased by 7,550. And so we're going to do an increase to our cash of 7,550. Again, the logic there is accounts payable is money owed to us by our customers. I'm sorry, it's money we owe to our suppliers. And so if we were to pay off everything we bought from them exactly, there'd be no change in our accounts payable. So if it goes up, it means we haven't paid for everything we've purchased from them, which means we spent less cash. So an increase there will be an increase to our cash. All right. So that gives us all of the adjustment information. The one thing that we didn't have on this one that sometimes you will see is you'll see a gain on the income statement from the sale of a long-term investment, or a loss from the sale of a long-term investment. And if we had a gain, what we would do is subtract that out, or a loss, we would add it back in, only because any money we've made by selling long-term investments like land or equipment or buildings is going to be handled down below in the investing activities section. If we were to count it up in the operating and then again in the investing, we'd be double counting it. So that's the other thing that this one didn't have, but sometimes you'll see. All right, so I'm going to take my net income, 257,380. I'm going to add my depreciation, 49,600. I'm going to add that adjustment for the decrease in accounts receivable, 10,100. I'm going to subtract the adjustment for the increase in inventories, 12,890. I'm going to subtract the adjustment for the increase in prepaid expenses, and I'm going to add the increase in accounts payable. Whoops. There we go. That gives me $309,340. I'm going to do is use a check here because, as you can imagine, it'd be easy to make an error with all these little things going on. But it looks like we're good. And because it's kind of the end of a section. So there's my first check. All right. So now we're into the cash flow from investing activities section. Remember, investing is just any purchase or sale of property, plant, and equipment, long-term assets, non-current assets. We can see here that our assets went from $320,700 to $390,890. So that looks like our equipment asset did that. So that looks like an increase of about what, $70,190. That's not about, that's exactly. The question is not really how much the asset increased or changed, but how much cash did we pay out? And so we have to have additional information. And here we can see equipment was purchased at a cost of $96,810. And fully depreciated equipment costing $26,620 was discarded with no salvage value realized. And so we can see that we actually paid $96,810 in cash for new equipment. We could check that if we wanted to by doing a T account, where in essence we would say at the beginning of the period, equipment had a balance, a debit balance of $320,700. At the end of the period, it had a debit balance of $390,890. During the period, $26,620 was credited to the account because we discarded this equipment. And then also during the period, a certain amount was debited to the account because we had to bring it up to the ending value of $398.90. And what we would find is that amount is $96,810. Again, that's just another way of checking it if you want to, is to do a T account. But this gives us the amount of equipment was purchased, $96,810. So we're going to say cash paid for equipment. That's a negative because it's an asset going up. And because if you just think about it, to buy the equipment, it would cost cash. So our net cash flow used from investing activities is negative $96,810. Finally, we have our financing activities. It's traditional on an income statement that we usually handle the equity transactions first, those that deal with stock, and then the ones that deal with liabilities, the debt transactions second. I don't know that that's a rule that it has to follow, but it's how you often see it, and it's how this one's set up. So we have three things going on from a financing standpoint. We have a mortgage note payable that allowed early payment, and you can see our balance last year was $203,400. Now our balance is $0, so we paid off that whole mortgage note. We also see that they issued 8,000 shares of common stock for $16 in cash, which means our common stock with $1 par increased by 8,000, and then our paid in capital in excess of par increased by, well, if it was $1 par, then it would be $15 a share times the 8,000 shares. That's the amount of the increase there. And then we also see that we paid dividends of a certain amount. So we'll start with this increase due to the stock. Okay. So if we issued 8,000 shares for $16 each cash, I would just do $8,000 or 8,000 shares times $16. So we brought in cash received from sale of common stock, $128,000. Next, we paid a cash dividend of $156,840. So we'll say cash paid for dividends. And that's a negative because we're paying cash out. And then finally, we'll have our note payable that we paid off, which was $203,400. And since we paid it off, that's a negative. So we're going to say paid cash, cash paid for to retire the mortgage note payable. There it is. So negative 203,400. So our net cash flow used from financing activities, we'll just add those up. 128,000 minus 156,840 minus 203,400. So we used negative 232,240 for our financing activities. Issued some stock, paid off some debt, and paid some dividends. So I think this is another good point to check to make sure I didn't make any errors. And it looks like I'm good. So now we're in the final stretch. So this line right here, we're going to find our either our net increase or decrease in cash. We won't really know what it is until we've added all these up. But all I'm going to do is I'm going to take my net cash flow from operating activities, plus or minus. So this one's minus my net cash flow from investing activities, and then minus my net cash flow for financing activities. And that will give me my total cash either used or received. So 309,340 minus 96,810 minus 232,240. So we can see I used $19,710 more cash than I brought in. We'll say net decrease in cash. Then we're going to go to our balance sheet and we're going to look at what our cash balance was at the beginning of the year. And so we use this one, even though it says December 31st, 2017, that's going to be the same amount. That's our end of last year. We can use also as the beginning of this year. So 107,130. And then we can see what the cash should end up being at the end of the year, December 31st of 2018. So what we do is we're going to just add these two together. So we have our decrease in cash and our cash balance. So negative 19,710 plus 107,130. And if we did it right, it should come out to our cash at the end of the year, 87,420, which it does. So that's a good sign that we did everything right. And that's it. So let's double check. Got 100%. That's it. So hopefully that will help you work through this problem and then help you with the problems that you'll face later in the chapter.